we watched the playoff game, and my mate reckoned, Soupy reckoned total fit, like if you go up, that game probably is worth like 200 million. When you include TV rights, and then if you go down straight away, you've got 2 years of parachute payments, which is 60 million.
Oh, that's a lot, isn't it? I was always aware there was the £100 million game, but £200 million is just.
I don't know. I just think like maybe this is an old man as you get older, but like the money in football is just really starting to put me off. It's just getting out of control.
Are there any like Bentley dealers in and around Luton that we can go along? There's a bit of cash going that way, isn't
I think those boys are going to spend most of their bonus in Vegas at the weekend.
Probably. Weekend.
Yeah, that was good. Good for them.
Yeah.
Are we good? Should we get on with it?
Yeah, let's go.
Welcome, Taking Stock, After the Bell, episode 8.
8.
One-on-one, mano-a-mano, with the intellectual heavyweight that is Mr. Jonathan Raymond.
Crikey, been called lots of things.
JR, how are you keeping, my friend?
Well, thank you. Well, a bit tired after a week on holiday with the children. It's not a rest anymore to go on holiday, apparently. But it was lovely.
We were herding 1 and 2 year olds at my mate's barbecue at the weekend, so
amazing.
I would say empathise, but it was about 3 hours and I was knackered, so I can't really.
No. It's nice thing. It was nice.
That's mint. So where to begin? I think there's only one place we can begin this week. Nvidia. Nvidia's numbers last Thursday, wasn't it? Set a record for the biggest single day increase in market cap ever. The US stock market up 200 billion. They added in market cap in a day. The previous record was 190 billion for Microsoft. They had an original guide for next quarter for 7 billion of revenue, and they're going to do 11.
It's a lot, isn't it?
I mean, it's a big old difference.
It was actually Wednesday night, and dare I say it, I was actually watching CNBC when the numbers hit the tape. So I was excited.
The sort of man you are, Johnny.
I know.
Wednesday night after the bell, was it? And then the big move was on Thursday.
Big move after hours.
Yeah, I mean, the first thing to say is, like, this is one of the top 10 biggest companies in the world.
Top 5 now. It's just got in. Oh, sorry, it's top 5 in the US, so it'll be top 10 in the world.
It's trading like a penny stock.
It's gone up. But it's. We've got the price chart here as the top pane, but from a year ago, it's more than doubled. But what we don't see on this chart is if you go back through 2020, 2021, 2022, it actually has fallen quite a long way. So I think the stock peaked at $300, didn't it? And it got down to about $120, and it's nearly $400 today. So it has round tripped a long way, but the rise in the last, it's doubled so far, more than doubled so far this year in 2023 alone, and we're only 5 months in. So it's been extraordinary. But then, if everyone talks about technology and adoption and AI, which is the story here.
So talk a little bit more about that. What, we sit close to this, but if you're someone who's coming at this from the outside and you see a lot of in the press about Nvidia, what's the story here? What's the narrative?
Well, it's the picks and shovels in the gold rush. This is basically as simple as you can describe it. They make the computer processing units and the GPUs that go into the computing power behind artificial intelligent robots, mainly generative AI, such as ChatGPT. And when you go to Google and type in something, as in who was the King of England in 1452, Google pulls up a load of websites and you visit other websites, which doesn't take a lot of computing power. Whereas if you go to ChatGPT and put the same question in, ChatGPT does the work for you. So it scans its database and the internet, and it gives you the answer, which takes an order of magnitude of a lot more computing power to do that, rather than just pulling up a list of answers to send you to a load of websites.
The technological engine in the car has to be a lot bigger.
A lot bigger, 100%.
Okay. And they're making the engines.
And they're making the bits that go into the engine. And the one thing about it is that there are not many companies making the bits of the engine.
Yeah. So
there's a scarcity value to what they do.
Okay.
So we may come and talk about it, but the difference between now and the dot-com boom of the late 90s, early noughties, was that in those days you had lots of companies that you could go and buy if you wanted exposure to the internet as a new thing. You could go and buy Cisco, Sun Microsystems as it was in those days, Oracle, IBM to a degree, or you could go and buy Pets.com, or you could buy Amazon, or you could buy Microsoft. So there's lots of different ways of playing the internet, or Vodafone, I guess, for in the UK, and BT were the two big, huge beneficiaries here. But in the AI space, you've actually got quite a narrow suite of companies, because there aren't that many companies who are sold.
I think the supply is coming.
Oh, supply's coming, don't you worry.
Don't you worry.
But
What was it
today,
you said to me the other day, when the ducks are quacking,
when
you've
the
got
ducks
to feed them?
feed them, exactly right. And it's fair to say the ducks are most definitely quacking today.
So you're gonna see an all like companies who have nothing to do with AI starting to reference. I think you've actually mentioned it here in the pack, isn't it, John? This is one of your charts you sent me.
Yeah.
Not the Google searches. So earnings season AI mentions.
Yeah.
And look at that. If you want to get a little short-term pop in your share price, you know what to say.
Definitely. So So this chart is taken from transcripts of company earnings calls. And the number of mentions by those companies of AI has gone literally parabolic, which you'd kind of expect. And sort of allied to that is the whole theme in the first place, the Google search data, which we've also got. So if you index the number of Google searches for artificial intelligence here in blue, it's gone up a lot. But the chart also shows the index searches of Bitcoin, which has had two big spikes, one in 2017 and another one in 2020, and Metaverse, which had a big spike in early 2022 when Facebook decided that was the start. So, I guess you could take this back further and put other kind of search terms in here like internet or .com and go back to 2000 and you probably see some similar results. But, it is the trend of the moment.
I mean, we'll come back to NVIDIA in a moment, but I wrote something about this morning, or came out this morning. Investment fads are a lot like fashion fads sometimes. I think AI is certainly going to be stickier than the metaverse, for instance, and find more long-term use applications. But these hot trends and fashions do come and they do go. And in the short term, probably there will be some disappointment around AI, and the narrative probably will fall away a little bit.
I think it's easy to see how AI has more wide-scale adoption potential in the shorter term than particularly metaverse, and more widely crypto. So there are some potentially quite interesting uses of crypto and blockchain technology as a means of payment or as a database system.
Yeah.
But it's not going to be in our everyday lives. AI and ChatGPT in particular, has the potential to be used by lots of us, particularly those of us in white collar jobs.
Do you think it's a threat to investment advisors, financial advisors?
Do I think it's the threat? That might be. Well, that might
not
be
to you, because you know what you're doing.
Thanks, Dave. Potentially, yes, but I also think its initial use case is going to be in taking away a lot of the drudgery of our day-to-day job.
100%.
So let's get that done first, and then let's worry about the next step. Ultimately, as we talked about before, human beings like talking to human beings, particularly as far as money goes, because it's quite an emotional topic, and I don't think that's going away anytime soon.
I think you can use it to do quite a lot of heavy lifting, like draft an email to a client who's concerned about the market in style of Jonathan Raymond.
Yeah.
That would be, frankly, transformational, the ability to do something like that.
And when we go see clients, we prepare reports of performance and valuations and some charts and things, and that takes time for someone, and that's the sort of thing that AI can do relatively quickly and relatively easily, and it probably needs tweaking, etc. But it's, again, it's taking away some of that drudgery. So let's get that done first, and then let's see kind of where it leads from there.
Free up the time to focus on the good
other
stuff.
Things. Yeah.
There's two things in NVIDIA I want to talk about just before we move on. This thing's going to be the new Tesla. You're going to have an opinion on NVIDIA, I think. It's going to be the sort of thing on Twitter that divides people into bulls and bears. There's going to be no middle ground, and you're going to be asked by clients in meetings what your opinion is on it. I think that's pretty unhelpful, because I don't think you need to swing at every pitch that you're bold, I suppose, would be the first observation. But I just think this has a feel to me of a stock that's moves are going to be completely wild, really out of control. I mean, it went up 25% a day, so already we're seeing that, but I think it's just going to be such a divisive thing, and I think a lot of people are going to get run over trying to short it.
Agreed.
Don't short something that is... I actually don't... I mean, it may or may not be overvalued or undervalued. We'll find out. But when these things trade on, we'll go back to the first chart that we had. We had Nvidia price in the top pane here and price to earnings in the bottom pane, and it's 55 times earnings. Why should it trade on 55 times versus 65 versus 45?
Yeah, exactly. And the valuation range has been 70 to 50 in the last 3 to 6 months. But even going back, it was on 35 times a year ago. So these things can move around a huge amount in terms of valuation based on feeling, sentiment, what they say, what new products they release, the hype cycle generally. So I totally agree. It might be less divisive than Tesla because the man at the top isn't Elon Musk.
Well, who's the CEO? I mean, I don't even know the chief executive.
Jensen, somebody whose name forgets me. So
probably a good sign.
I recognise him if I saw him. But yeah, exactly right. So it might be a bit less divisive than that. And they don't quite have the same. Musk wants to take over the world basically, doesn't he? And Tesla is this platform to do so, whereas Nvidia, these guys are just making really, really good chips that are really widely used, both in AI and in other areas as well. So you're absolutely right, but we just need to be. I think I agree with you. You don't need to play at every game in this business. You can just let things pass and watch with interest.
I guess my point is that maybe it's a more modern thing. We all feel we need to have an opinion on everything, and
we have FOMO as well, though, don't we? It's the old classic. Why don't we put £1,000 into that a few months ago? I'll be rich by now.
Well, our in-house podcast producer is already dabbling in it.
Well, there we go. He's QC's best trader.
Good for him. The other thing I was going to say is, when something like this you're trading at 45, 55 times, it reminds me a bit of, do you remember Wile E. Coyote used to chase Roadrunner off the cliff? Mm-hmm. There'd be that moment where his legs were spinning, but
he would before he started falling back down to earth.
When these things fall out of favour, it's not like there's a sensible valuation level to carry them.
No, 100%, and that's already happened in the last 18 months. We've got very short memories here.
Of course we do.
Zoom and Peloton are back below where they were before the pandemic started. Zoom is on 12 times earnings. I mean, it's mad. No one had heard of Zoom before the pandemic, very few had heard of Zoom pandemic. It's become ubiquitous and it's grown its sales and revenues multiple since 2020, but the stock is lower than it was then. So you're absolutely right. When these things start unwinding, there really is no kind of, there is no flaw.
Well, so, as you've sort of pointed out, I mean, you can have unbelievably good companies. Excuse me. So this is Microsoft, isn't it?
It is.
Microsoft valuation and earnings are in the middle, are they?
So the earnings per share is the middle pane here. Yeah, the price is the top pane. And
so price has gone up over the long term. Earnings have gone up because, as we know, Microsoft is a ridiculously good company.
Yeah.
But
if the valuation's gone down.
And the valuation's gone down. So I think the executive summary is you can have the best company in the world, but if you pay too much for it.
So if you look in 99, 2000, the peak of the dot-com mania, Microsoft shares got to $60 a share. At that time, the earnings were less than $1. It was about 80 cents a share. And so correspondingly, the price-earnings ratio, which is one divided by the other, was basically 60. So at the time, you were buying a $60 stock with $1 of earnings, 60 times PE. If you held Microsoft shares went from $60 to $18 in 2009, so they fell by 3/4. And then they recovered back to $60 in 2015. So in 2015, you got back to your in point if you happened to buy them at the peak of $60. Now in 2015, the earnings were no longer $1 a share. The earnings were over $2.50 a share. And if you look at that earnings chart, it goes up in a straight line, pretty much with the odd blip around the financial crisis. And there was a bit of accounting funnies in 2012.
Accounting funnies.
Because that was that was Nadella when he first joined the business, and he basically kitchen sinked the whole thing. So the company, from a fundamental perspective, if you look at that middle pane, have delivered serious increase in growth in profits per share over that 15-year span. Share price has gone nowhere. So that goes to show to you what can happen if you overpay for a stock, even if it then generates the growth that you hoped it would generate. Just because the valuation unwinds over that 15-year period. And you could buy it in 2015 for 15 times earnings. You could buy it for 10 times earnings at the low in 2011, 2012. So I'm not saying that that's what's going to happen to Nvidia, but if we're sat here in 15 years' time, it's a big if, then it's not, Nvidia might not be on 60 times, it might be on 15 times, and the stock's gone nowhere. They have grown the earnings.
This is what people feel to get, because it's difficult to get your head around. There's two bits to this. Are the earnings going to go up? Well, for something like Nvidia, clearly, absolutely yes, and they're potentially going to go up by an awful lot. But what is that earning stream worth? And if you overpay for that earning stream, it's probably not going to be a great investment. Yep. If you underpay for that earning stream, it's going to be a great investment. That's value investing 101, right? So it can be difficult for us to get our head around. I mean, the obvious analogy is horse racing. You don't always bet in the favourite. If you get betting on the favourite, you'd bleed out after a while. Sometimes you have to look for slightly better odds, and that's why people look for slightly cheaper companies. We were talking about the Bank of England a couple of weeks ago. We've subsequently had the inflation report that we mentioned when we spoke about it. I think it's fair to say it's not what they wanted to see. Inflation is taking a lot longer to expunge from the UK economy than it is certainly elsewhere in the world. I think we've talked about that previously. Main issue here is food inflation. Food inflation is like 20%. I mean, you're from a farming background.
Farming stock, yeah.
I mean, what's going on here, John?
Well, these things do have long lag times and long lead times, both on the upside and the downside. So the UK is not necessarily an outlier globally, although it's a little bit of an outlier. Supermarkets are not profiteering because supermarket margins are 3 or 4%, so it's not super profitable business selling food. It's a high volume, low margin game.
Yeah.
But producing food from a primary producer end has a long lead time, whether that's milk, potatoes, or wheat, or bread, or whatever it might be. And then you've got the people in the middle that process the primary product, and all their cost structures have gone up as well. So if you think about packaging costs, labour costs have gone up a huge amount. There's a lot of energy needed in the supply chain between processing the actual stuff and the transport and logistics side of it as well. So all of that has had to be built into the price, and a lot of those costs haven't fallen. They might have stopped going up, in terms of fuel and energy in particular, but they haven't yet come down materially enough so that food prices at the shop can start coming down. It's just lag times and lead times it's going to work through, and it's proving sticky. And I would probably say, and I might be a bit biased, but the whole supply chain from the supermarket back down to the primary producer has probably been starved of margin, i.e. it's not been a very profitable business for the last 20 years.
No.
Because it's been very competitive, and the supermarkets have been very efficient in their pricing, ruthless some might say, and I think rightly from a long-term perspective some of that margin is being rebuilt into the supply chain, which is a good thing from a long-term perspective, because if you don't have any margin you don't get any investment and you don't get any growth, and we end up losing a large part of our kind of food sector. So it's going to take time. I think the inflation number will come down, but I don't think we're going to see wholesale falls in the price of food in the shops anytime soon, unfortunately.
I mean, you say there about what are the forces that have made, from reading between the lines, what you're saying, farming's quite a competitive, difficult business. I mean, what are the headwinds this sort of industry is faced?
Well, you base on global commodity markets are just that. So farmers are price takers essentially for most of the stuff they produce, whether that's like beef or wheat or milk or poultry, etc. And so just been driven by weather issues in South America, or in Ukraine can't export wheat, or China pig issues, or whatever it might be. Lots of factors kind of impact that. And most farmers who are producing primary produce don't really have an option of selling it somewhere else for a higher price, because the price is the price.
Yeah, it's not as if you can go and play off the supermarkets against each other. You need to deal with who you're going to deal with.
Exactly.
So food inflation is as you can see there pretty intense, up towards 20% year on year. Inflation is coming down, so that's the good thing. It's just taking a lot longer than people would have thought. Counterpoint to that, it's a stat that we've mentioned a couple of times, or it's a theme that we've mentioned a couple of times around mortgage refinancing. There's 1.4 million households with fixed rate mortgage deals due to expire over the coming year.
Yeah, so 1.4 million a lot. Was it 30 million households in the UK?
It's if you assume 3.5-4% higher mortgage every year.
Yeah.
I mean, it's going to affect your spending probably.
Definitely, because it's quite a material jump for most people's mortgage costs. £200-300 a month for any household is going to be meaningful and noticeable, isn't it? So if it's £500-600, then that's a lot. So it is going to have an impact. As we've talked before, it's a slow moving impact. It's only as people's fixed rates roll off that they see the impact on their bank account month on month.
Mm-hmm.
And I think we're just going to have to kind of see how it goes for the next few months. Is there some evidence that there is some trading down and some weakness in discretionary spending in the UK?
Not really.
It's not obvious.
In Liverpool at the weekend, there definitely wasn't.
Oh, there we go. Well, that's because the Toffees stayed up there, didn't they? So they're all partying like mad.
Yes. Yeah. I mean, it. Sort of light-hearted point, but it is true. I mean, you go out for dinner, you go out to the pub, and places are packed.
They are, but I mean, I try not to let the sort of London southeast bubble kind of cloud my view on that. But definitely, it doesn't feel like a recession when you walk around.
No, but that's conversely then is good news, bad news, and vice versa in terms of.
Well, maybe the Bank of England need to go to 6%, which would cause a few more problems, wouldn't it?
Wow, I've been wrong on rates the whole time.
You've been wrong on rates the whole time, exactly.
So
yeah, good to admit you're
wrong. Don't make predictions. One of the knock-on impacts though of UK inflation, when you look at bond markets, is that the spread that you can see here, so basically the extra return that you're getting from lending to the UK government versus our friends in the States, is as high as it's been in the last 10 years.
Mm. And that's down to that sticky inflation story as well. I mean, inflation in the US is coming down much quicker than it is in the UK. They're now down to a 5.5 handle, whereas in the UK we're still in the 8s, and therefore investors in government bonds, if they think inflation in the UK is going to be higher, demand a higher return on our bonds to protect against that inflation.
And this has been happening at a time when the US government has begun negotiating to avoid defaulting on the debt effectively. So basically shows you how much inflation has an impact there.
Yep.
You got me to throw this one in as well. I mean, this is the 2-year, the 20-year, and the 30-year gilt yields. So rates, as we can see there, they're not quite back to where they were post the mini budget, but they're not far off.
They're pretty much at the long end. So the 30 is back over 4.5%, which is where it was in the aftermath of the mini budget, and it's just quietly ground higher in the last few months. So the 10-year was, 3.5 at the start of the year, and it's kind of nearly 4.5 today. And I think, as we've spoken before, it's a big problem for Jeremy Hunt and the Chancellor if I think a 1% rise in government bond yields costs the Exchequer an extra 28 billion a year in interest cost. It's a lot of money. So, I wouldn't be looking at this chart as a Chancellor, or as the Chancellor, and feeling too warm and fuzzy inside, because I think, and that comes back to the point about inflation. If you can knock inflation on the head, even if it takes something resembling a mild recession, where not too many people lose their jobs,
that'd snap your hand off for a mild recession,
and base rates can go back to something with a 2 or a 3 handle, 2-3%. I think, bring bond yields back down again, and that would have a nice release valve on the public finances. But as it stands, tricky.
Yeah, I mean, my fairly basic theory on this is that people are incentivized to get inflation down and get rates down, and that's what will happen. It might take longer than they would hope, but that's basically what but that's reliant on, probably going back, talking out both sides of my mouth, relies on people spending less money, and people are determined to enjoy themselves after the events of a couple of years ago, and you can't obviously blame people for doing that. I saw a stat in an article from the Wall Street Journal over the weekend that caught my eye. New York City's vacant office space could fill 26.5 Empire State buildings. London's potentially a little bit different, but New Yorkers are not going back to work seemingly in the office.
No, and I think the stats I've seen is that office occupancy is 50% of pre-pandemic levels, and it's been stuck at 50% for quite a long time.
Expect that? Is that the sort of level you would have guessed?
No, I would have guessed higher. So I would have guessed like 70% of pre-pandemic levels.
Yeah,
probably. But again, I think we've mentioned this before, but what does a recession do for getting people back to the office? I mean, if you think your job's under threat, are you going to spend more time at your desk next to your boss or not?
That's
the answer's probably more.
Theory.
But it has been pretty sticky, and doesn't seem to be going up. So there is a bit of an issue there, and this comes back to the sort of thing about Silicon Valley Bank and First Republic and the US regional bank story. A lot of US commercial real estate or offices, a lot of the debt is held on these banks' balance sheets. So it doesn't seem to be a problem of magnitude of subprime mortgages, for instance, but it could be a pretty big problem for some of these banks if some of these, refinances coming up and they can't roll the debt over very easily and the asset's not worth what it was. Could be, I'm not saying systemic, but it could be a problem for the banking system and the wider economy as well. So, yeah, I mean, there's lots of reasons to be bearish on US commercial real estate. I don't know what the numbers are for London offices or UK offices, but I think the US is faring a good bit worse than the rest of the world, particularly London.
I don't know. I would hazard a guess that the UK occupancy is a bit higher.
You'd think so. Walking around the city midweek and in London midweek. It's
midweek,
busy.
But then you get into the summer and everyone starts playing golf.
Do they? That's half term this week as well. So
it is. I need to talk to you as well. I've just been, my mate stayed with us for a couple of days, gave me £150 American Golf voucher. Yeah, I'm going to get a new putter. Because new equipment solves all your problems, right?
It does, yeah. Or you could buy, I don't know, what's that, a month's supply of new golf balls?
Some nice ones to carve into the lake.
Yeah.
So something we've picked up on a couple of times over the last couple of weeks. Gonna give it a name, probably the life jacket trade isn't a bad one. So you've got these stocks that are like consumer staples, trading at very high valuations, and I think that's people buying life jackets, whether or not they're going to need them, because you're going to need to hide out in safety. And the counter of that, other side of that, is that if you've got the safe stuff that's really expensive, the economically sensitive stuff, in theory, is pretty cheap. And what you've got here is a chart of the market cap of Meta. Versus,
formerly known as Facebook.
Yeah, Facebook versus the top 5 mining companies globally, and Meta is a larger market cap than all 5 of those companies put together, and you're getting 2.5
so
the free cash flow yield.
Those top 5 mining stocks generate double the free cash flow yield that Meta does on a combined basis.
So cash profit, is that, or
yeah, cash after all investment and dividends, etc.
How do you explain that to someone? Why that? Because that sounds completely illogical.
Well, that's what we're here for, isn't it? 2 things, I guess. The profit stream from those mining stocks is a lot more volatile because they're reliant on copper and iron ore prices, which go up and down and up and down. And secondly, the growth of Meta is a bit more consistent, or estimated to be a bit more consistent, and you've got a little bit more, that free cash flow. Meta's perhaps not the best example given what it's been through in the last 12 months, but generally speaking, a good quality growth tech stock, you can estimate within a relative tolerance of what the profits are going to do next year and the year after and the year after. With these mining stocks, you don't have that. So I think that's probably the main part. But it's pretty extraordinary, and we've talked about if we are transitioning to a non-fossil fuel world, you need a lot of copper, a lot of iron ore.
so this chart here, which is the materials used in clean energy tech, so things like electric cars, conventional cars, offshore wind, onshore wind, lots of copper, lots of lithium, lots of nickel, zinc,
All that good stuff. Yeah.
And the companies that are digging this stuff out of the ground are those miners,
Yeah,
broadly
absolutely
speaking.
right.
I mean, those are the big five majors. So, potentially long term a decent structural growth play there on a fairly keen valuation. But I think with these things, you've got to be prepared to look a bit silly in the next 12 to 18 months, because if we get a recession and you buy something cyclical going into a recession, it's probably not going to do too well, I would have thought.
No, and not dissimilar to kind of Nvidia. If we look at the Rio Tinto share price from the start of the pandemic, it was £40 a share. It's been up to 60, back down to 45, back up to 60, back down to 40, up to 63, and it's now down at 48. So the share prices are pretty volatile, and therefore, you do have that volatility in the share price in a not dissimilar way that you do in Nvidia. So you just have to be slightly careful. But I think medium term, as we've talked about with the oil stocks, now you can very easily make quite a bullish case for owning a basket.
I think I'd rather buy a miner than an oil stock today, personally speaking.
No, that's probably fair. Yeah,
Just
I
on
can see that.
relative valuation.
Valuations are good. Bit less recession risk, I guess. In a recession, the oil price tends to get hit quite hard, so you do have a bit more risk in the earnings stream of the oil companies.
I went back and did. I don't think I ever ended up doing anything on it, but recessions going back to 1970, how various assets did, with the exception of 73, which was the oil price shock.
Yeah.
Oil just gets taken out to the
Oh
woodshed.
yeah.
So
That makes sense.
quite a cyclical asset, pretty
Makes
unsurprising.
sense.
Final things, I think we're coming up on time. Recent Gallup poll of US citizens, 58% said that they owned stocks through some kind of stock account, share account. I think most people would say lower in the UK. I don't think we just don't have the same sort of culture of share ownership as our friends in the States have. But 58% sounds low to me.
58 does sound low.
I think there's probably people that aren't aware that they
Well,
have
so
share
that would be my point. So pretty much everyone in the UK has a pension scheme of some description, and within
Yeah.
that pension scheme there will be equities. Do people who have got a pension, if they were asked, do you own shares, they'd probably say no without really thinking through, well, actually I've got a pension and I've got some Apple in my pension, so that's a share. So the answer is yes. So my best guess is it's kind of difficult to ask the question and difficult for people to know, really, isn't it? Would it be the same in the US? I mean, the US have got the 401ks, which is a very similar structure.
I don't think they've got auto enrolment,
No, I think you're right, actually.
which we obviously do have in the UK, but I think the main gap here is knowing that, is being an investor in the first place and knowing that you're an investor, and I think quite a lot of people would be unaware of that fact. They are actually shareholders in some of the best businesses in the world, which the industry, I think, could do a bit of a better job in communicating to people.
Yeah. Well, I think share ownership in Europe is a lot lower than it even is in the UK, which is a lot lower than it is in the US, and that's
Really?
kind of as much a cultural thing as anything, I think.
Why is that? Because
Tends to be
Europeans
property.
typically don't, well, not typically, but the property ownership rates are lower, aren't they?
Ownership
As well?
rates are lower, yeah. I don't know, but they again, they've got, defined benefit pensions, haven't they, and life insurance schemes and those sorts of pots of savings, rather than the direct share account, investment account type thing.
Yeah.
And culture, I guess.
Culture. They need to take a leaf out of young Alex's
They
book
do,
and load up
yeah.
on Meta and Nvidia.
Yeah. And
Good
why not
man.
too?
Clean it up. Thanks very much, mate. What are you up to?
Thanks,
what are you up to next couple of days?
Off on my travels out to see clients tomorrow down to the West Country. That'd be
Lovely.
nice. Yeah.
That'd be nice.
A few podcasts in the car.
You don't listen to us, do you?
No, I won't be tomorrow. No.
Listen back.
How about you?
I've got the Succession finale tonight. Sarah's coming around to
Don't
watch
say
the
anything. We're
Succession
still
finale.
on season 1. I mean, it's so good. We don't want to rush through it, so we are getting towards the end of season 1, and it's first class TV. Really is first class.
Your man, what's his name, that plays Tom?
Yeah.
Can't remember the name of the actor. everything he is in, he is absolutely fantastic.
Yeah,
And
he's
Kieran
good, actually.
Culkin is unbelievable in it.
Yeah.
I saw Brian Cox had a couple of things to say about no spoilers about this series.
Mhm.
But yeah, it's been absolutely fantastic.
It's great TV.
It is the sort of TV show that when people tell me they haven't watched, I'm jealous of the
Yeah.
fact that they've still got to watch it. So if you haven't seen that, check it out.
Top tip.
Johnny, thanks very much.
Thank you, David.
Alex,
Till
thank you
next
very
time.
much.
Thanks.
Folks, thank you very much for sticking around and watching us. We will obviously if you have any questions or want us to cover anything, then hit me up at dave.henry@culturecheviot.com. Otherwise, we will see you in a couple of weeks.